Hey, thanks for watching this video here. My name is Matt Benson. I run a financial planning firm in Chandler. I'm going to talk today for our blog about tax-efficient retirement distributions. So I'm going to go ahead and share my screen here, and we will dive in. And so, give me just a sec. All right, so the first thing I think that's really important to understand about retirement distributions is that not all income is taxed the same way. And so this might be intuitive, but this understanding of this is paramount to having any sort of tax plan. So in other words, distributions from your IRAs, from your 401ks, and your Roth IRAs and things like that are not all taxed the same way. So I'm going to basically I'll call it four different types of investment accounts that you could have. We'll call it pre-tax, or I've written IRA since that's commonly where people are taking their distributions from. We've got Roth, non-retirement accounts, and then health savings accounts. Typically, for most of our clients, their largest portion of their assets are here. Or here, oftentimes if they're a business owner, they may have a large portion in a non-retirement account, or if they had a large portion of compensation from RSUs or stock options and stuff like that. And so what I'm going to illustrate here is simply how different accounts are taxed. Again, this may be, somewhat intuitive, but this is very, very important to understand before you even take the next step. So we have pre-tax accounts. Those accounts, when you put money in, you get a tax deduction. So if you made $100,000 and you put $10,000 into your 401k pre-tax, you get a tax deduction. That money grows tax deferred. When you take the money out, you pay tax at, this is important, ordinary income rates. Ordinary income rates when you retire. Need to be over age 59 and a half to access this without penalty or an exception. Roth, put the money in today. No tax benefit. Make $100,000, you put 10,000 in, you're still taxed as if you made 100. That money then grows tax-free and it comes out tax-free. The gains, the earnings, everything. So if you put 10,000 in and it grows to 30,000, you take 30,000 out with no tax consequence. Non-retirement accounts, again, these pre-tax and Roth, both of these here, 59 and a half rules. Non-retirement accounts don't get the tax benefits of it. So that's after-tax contribution. Dividends and capital gains are taxable. And then when you ultimately, as the account grows, dividends are taxable. And then when you sell it, the gain is taxable. The difference here, though, is if you hold this over 12 months, this is taxed at long-term capital gains rate here. And that's advantageous because obviously nowhere near as tax efficient as pre-tax and Roth accounts. However, the advantage to it is that there's no contribution limit, and you can access this money before 59 and a half without penalty. So 59 and a half doesn't matter for these non-retirement accounts. The other thing on non-retirement accounts, again, long-term capital gains rate. So there's three brackets for this, and we're going to go over them in detail here in just a second, but it's 0%, 15%, and 20%. And then the last one here is a health savings account. Now, a lot of times I think this is a common misnomer, and we have separate blog posts where we get into, HSA specifically, but a lot of people will just use your health savings account like it's a health savings account. And oftentimes we encourage clients to view it as almost like an extra retirement account that they can make contributions to. So this health savings account, when you make contributions, you get a tax deduction. If you can invest the money just like in your 401k, it's your money when you leave your employer. And that money grows tax-free, and you can pull that money out tax-free as long as it's used for healthcare expenses. Now, you don't have to have those healthcare expenses occur in that year. So a lot of times we'll tell clients to kind of stack up their healthcare receipts, and then take a distribution at some point in the future when they maybe need that more tax efficient distribution. The thing I wanted to review here is the difference between ordinary income tax and long-term capital gains. So You can see here, I'm showing here, this is single down here, and then this is married filing joint for ordinary income, you can see here. And so you can see in 2026, for married filing joint, your first 20, sorry, hard to underline there, or I'll change my pen color. Now I've erased basically half of it, but your first almost 25,000 is taxed at 10%. Then your next almost 75,000 is taxed at 12%. Then your next about 111,000 is taxed at 22, and then your next almost 200,000 is taxed at 24 before your next 112-ish is taxed at 32. And then next 250 at about 35, and then beyond that is taxed at 37. So that's married filing joint. Of course, if you're single, it's almost half of that is basically the way it ends up working. Long-term capital gains rate, you can see if your income is below 98,000, your long-term capital gains rate is 0%. Your 15% long-term capital gains bracket is quite large. So basically the next almost $500,000 is taxed at 15. If we're above that, then it's taxed at 20. So important to know these things, because if you are trying to take distributions from your investment accounts, say that you're trying to stay within the 22% tax bracket here. And in 2026, you can see that's $211,000 here. So let's say that your normal income ends up being about 180,000 of taxable, and our target for the top of the 22 is 211,000. So we have about $30,000 to work with to and not go up to the next tax bracket. Now, there's some other nuanced things that you need to consider here, because I'm only looking at income tax brackets, but there's also Medicare thresholds that you need to consider as well, Part B threshold. So if you're under 65, it's one thing. If you're over 65, it's another thing. And all of these things are things that we think through with our clients. But let's say that you have a distribution. Let's say you're planning to buy a car, and the car costs $50,000, right? Now, of course, $50,000 in a pre-tax account is not the same as $50,000 in your bank, right? So you may need to take a distribution for 65,000 in order to net 50,000, potentially, depending on what your tax situation looks like, which is something that we help our clients think through. But let's say that you need 50,000 net, and you only have 30,000 to stay within that 22% tax bracket. So let's say that you've got an IRA that has a balance of $1 million, or combined between you and your spouse. You've got a Roth account that has 200,000 in it. And then you've got a non-qualified or non-retirement account with 100,000 in it that has a cost basis of we'll call it $60,000. So you have $40,000 in gain in that account. So a lot of different ways that we could net you 50,000 and still stay within this 22% tax bracket. We could say, let's do it, let's fund it all from Roth. So our Roth balance would go from 200,000 down to 150 now, and you'd have 50,000 in your bank. On your Roth account, 50,000 in your Roth account is the same as 50,000 in your bank account. In other words, you don't need to account for taxes on it because it's after-tax money, right? You could say, scenario 2, you could say, hey, let's go ahead and we'll just take 30,000 gross from our IRA, and then let's say that nets us 25 after taxes. And then we will take, the remainder from Roth, the other 25 from Roth. You could say, hey, we're going to do 30,000, kind of same type of idea from the IRA, or sorry, actually do a little bit less. So let's say that we did, 20,000 from the IRA, nets us 15K, and then we funded the rest from a non-retirement account here. So we need another 35,000 uh, net. Um, and we have 10,000 to work with in gain, which would work out pretty good in our scenario here. So we would take probably 40, let's see, our gain there'd be about 40% on that. So maybe we need to take about 45 there to net that 35. But anyway, all that to say is that when you're taking distributions, not all distributions are taxed the same way. You could even throw another wrinkle in here of saying, hey, you got, $100,000 in cash or something. Well, if you take 100,000 in cash, it's quite obviously not the same. You could, layer a scenario where you say you've got you're planning to do a $50,000 car purchase at some point in the next 9 months or 12 months or something. Well, you could say, hey, I want to fund this all from my IRA because I want my Roth account to sit there and just continue to grow. Right? Going back to my very first illustration here, every dollar, like in your Roth accounts, every dollar of gain that you have in here, you will not pay tax on. Every dollar of gain in your IRA, you will pay tax on. So what should that tell you about how you want these accounts to be allocated, how you want them to be invested? Your Roth accounts, you probably want to be a little bit more growth oriented. And you probably want those accounts to kind of sit there and bake for a little bit longer. So if ideally, if you don't need to tap into your Roth accounts, tap into your pre-tax accounts first. Leave those Roth accounts for some kind of unforeseen liquidity event, or just allow them to continue to grow. Because again, typically you're gonna have your more stable assets and your pre-tax accounts there, just to because every dollar that grows in there is going to be taxable, and every dollar that grows in the Roth account is tax free. So those are all things to consider when we're thinking about tax efficient retirement distributions. There's all sorts of other things that we need to consider in this, at different ages. So how does Social Security play into this? When do we want to elect to defer Social Security to a point in the future because 85% of that Social Security is going to be taxed. Do we defer Social Security so that we can create a larger gap in those gap years of retirement income? Do we uh, do we decide to use qualified charitable distributions once you reach RMD age? Do we decide to gift appreciated stock for more tax efficient ways to give? Do we decide to realize capital gains and what they call capital gain harvesting as opposed to capital loss? Capital loss harvesting. So anyway, all sorts of different strategies to consider in this here. And I have blog posts on all of those different topics that kind of get into a little more granular look at it. But this is just to, summarize kind of all of those things together and say that not all income is taxed the same way. And we just need to be mindful of that when we're taking distributions, particularly when we're trying to shoot at a certain income target. So anyway, I appreciate you watching. If you have any questions, feel free to reach out. Thanks for looking.